Gold is easily one of the most popular assets retail traders absolutely love
Gold
to trade.
is a popular
for good
and
reason.
volatile trading
It moves
asset.
a lot. If you manage to catch the right moves, it can be an incredibly profitable venture. In this comprehensive guide, I want to give you a high-level view of how to trade gold more profitably. I will share some key factors you need to consider in your fundamental and technical analysis before you start placing your trades. Let's jump right into the core dynamics of the precious metals market. If you have ever looked at a gold chart before, you already know, without a doubt, that it can become very, very volatile all of a sudden. But before we dive into a bunch of technical trading techniques, I want you to truly understand something about the very nature of this asset. Gold has been used for the last 5,000 years as a store of wealth and a medium of commerce throughout the ages. The reason I bring this up is because it possesses a unique trait that I believe nothing else in human history has. It has stood the test of time as a form of currency. It is a timeless way to store money, whereas every single fiat currency in the world has failed to exist long-term without eventually collapsing. That might sound strange to hear, but you can look back at history for examples, like the German mark. It was around for a very long time, yet it reached a point where it completely hyperinflated due to massive economic distress and political turmoil. The core point here is that gold holds a highly unique trait. It is what many traders and investors consider a safe haven asset. This status means that when global financial systems begin to fracture, loot wealth preservation. This brings me to my next point about trading gold. Again, you really need to understand the story and the concept behind gold before you start jumping into the charts. Gold is prone to sudden, impulsive moves. To show you what I mean, I want to look at a long-term chart briefly and talk about the major highs we have seen in the gold market over the past few decades. We can look at the historical peaks driven by global macroeconomic shocks. Historically, we all know what happens when global crises strike. We faced massive systemic disruptions during global health emergencies, geopolitical escalations, and military conflicts around the world. Furthermore, we have witnessed severe banking crises and high-profile collapses within the financial systems of developed nations. When commercial banks face liquidity shortfalls or insolvency risks, public trust in traditional banking dissipates rapidly. And my point in bringing all of this up is to show you a clear pattern. In all major historical scenarios where gold spiked back to historically high levels, the moves occurred during major crisis events, terrifying situations in the financial markets, and global instability. There is a very good reason for this. Gold tends to spike on fear. This is something you absolutely must know if you are going to trade it. Gold thrives in a fear-based environment. On top of understanding that, I want to touch briefly on the technical side of trading gold. Usually, my personal approach during times of heightened volatility is basically to be a trend follower. When these crisis events are unfolding, when markets are acting out of pure fear, and the gold market is rocketing upward, many counter-trend traders find themselves on the wrong side of the trade, deeply wishing they weren't. This isn't a new phenomenon either. Throughout history, there have been many periods where gold experienced ginormous run-ups. Another one that many of you are familiar with is the historic financial crisis of the late 2000s. Following that systemic mortgage market collapse, we saw the start of one of the biggest bull markets that ever occurred in the gold world. Of course, silver followed suit as well, but this breakdown is especially tailored to gold. During those years, central banks printed unprecedented amounts of money via quantitative easing, which permanently stoked fears of debasement and pushed precious metals to record valuations over a multi-year period. The next critical element you need to grasp if you're going to trade gold is that we have to pay close attention to the US dollar index, better known as the DXY. When we look at gold, it is quoted in US dollars. Because of that, I highly recommend doing something you can easily replicate on your own charts. Compare gold directly to the DXY. To do this effectively, I always utilize TradingView. TradingView allows you to overlay the DXY line chart directly on top of your gold candlestick chart, creating a clear visual reference for their correlation. When you do this, you will notice that, generally speaking, when the dollar is moving up, gold tends to move down. Conversely, when the dollar is moving down, gold tends to move up. It's almost like poetry. they rhyme in reverse. There are a number of economic reasons for this, but the basic idea is that because gold is priced in dollars, a stronger dollar means stronger purchasing power. You can essentially buy more gold for fewer dollars. That dynamic applies not just to people in the United States, but globally, since the US dollar is still the primary global reserve currency. When international governments, sovereign wealth funds, and institutional participants buy gold, they are usually buying it with US dollars. The point I am trying to drive home is that whether you are trading gold from a fundamental or a technical perspective, it is absolutely vital that you keep a close eye on what is happening to the US dollar. You can always pull up the index simply by searching for the ticker DXY on TradingView. It is a highly useful tool for market analysis. Perhaps whenever you are getting ready to analyze gold, you should take a look at the dollar index first, because wherever the dollar goes... Now, I can already hear the objections. Some people are going to say, but sometimes gold and the dollar move up at the very same time. And yes, that is true. Please understand that this inverse relationship is not a 100% guaranteed certainty every single time. There are rare moments of extreme global liquidity panics where investors liquidate everything to hoard cash, causing both the dollar and gold to temporarily spike together as safe havens while equities plunge. That naturally begs the next question. What exactly causes the US dollar to rise and fall? If we are tracking the dollar to see how it might impact the price of gold, there is something you need to be very aware of. Another major contributor to gold's upward or downward swings is how heavily the dollar is impacted by US monetary policy and overall economic health. Let's talk about monetary policy first, which means tracking what the Federal Reserve is going to do with benchmark interest rates. During cycles where monetary policy starts loosening further and further, gold skyrockets quite strongly. This happens because interest rates, which may have been raised dramatically in prior years to combat inflation, put a massive damper on gold. When the Federal Reserve backs off from an aggressive rate hiking cycle, that pressure is erased. You see, gold is a non-yielding asset. It does not pay a dividend or an interest coupon just for holding it. Therefore, generally speaking, rate hikes cause gold to deteriorate. This concept can be a bit confusing for some because sometimes people see CPI, which measures inflation, moving up, and they think, shouldn't gold be moving higher on higher inflation? It makes sense why traders think that way. They look at gold as a traditional hedge against inflation, so they expect inflation to drive gold prices up. However, it is a little trickier than that because of the monetary policy factor we just discussed. If rate hikes are inherently bad for gold because they signal that monetary policy is tightening, which means borrowing costs rise and liquidity dries up. On the flip side, if the inflation report shows CPI going down, the dynamic changes. It's not always a guaranteed reaction, but usually, when we have been dealing with elevated inflation and we finally see CPI, especially core CPI, start moving down toward the Fed's target, it generally triggers a rise in the price of gold. These are the core factors you want to consider when looking at gold. You always want to pay attention to the dollar. From a technical perspective, you may want to identify chart patterns that are actively occurring on the US dollar index using TradingView. For example, if I were to pull up the DXY on a 4-hour chart, and notice that the overall trend is very strong to the downside, breaking through key support levels and printing lower highs and lower lows, that technical weakness might give me the extra confirmation I need to look for long positions on gold. Remember, a weak dollar can cause a massive spike in gold. As a matter of fact, that is exactly what happens during periods of cooling inflation. We can watch the 4-hour chart show gold making a significant move higher on the back of a lower than expected CPI report. When inflation data comes in cooler than anticipated, the gold market absolutely loves it. Technical indicators like the Relative Strength Index, RSI, and Moving Average Convergence Divergence, MACD, on TradingView will often show bullish divergence on gold precisely when the DXY breaks below its crucial moving averages. So, if you're going to trade gold, here are a couple of practical things I would highly recommend you consider. Keep a close eye on the US dollar and always move with momentum. Personally, I prefer trading gold strictly in the direction of the current momentum. I'm not looking to counter-trend trade or fade the market. Another tip I would offer is to focus your trading on periods when momentum actively picks back up. When the markets are just grinding sideways and moving sluggishly in a tight consolidation bracket, that is probably a no-go zone. There's really nothing worth trading there, and you will likely get chopped up by spread and minor fluctuations. However, if you are bearish on gold because you are bullish on the dollar, for example, and the market starts moving cleanly out of a consolidation pattern, my next major tip for trading gold is to keep a sharp eye on what institutional money is doing with the precious metal. We want to see what hedge funds, money managers, and essentially the smart money are doing. There are a couple of things you can pay attention to when trying to track the big buyers and sellers. To analyze this effectively, institutional traders look at macro data feeds rather than retail broker sentiment. Believe it or not, central banks around the world actually accumulate massive physical gold holdings as part of their foreign exchange reserves, which is a fascinating study in itself. When global de-dollarization trends accelerate, central banks buy gold to diversify away from Western sovereign debt assets. But what macro traders look at most closely is specifically the commitments of traders report data, which tracks institutional-level traders like large speculators and asset management groups. When institutional money is overwhelmingly on the long side of the gold market, it creates a powerful structural tailwind. The reason this data matters so much to our analysis is simple. These institutional participants are some of the smartest, most well-capitalized entities in the financial markets. To build a complete market perspective, another element you should absolutely be paying attention to is the contrast between institutional positioning and retail trader behavior. What you will frequently notice on sentiment gauges provided by major multi-asset brokerages is that a massive percentage of retail traders are often found fighting strong trends. For instance, during an aggressive gold bull market, average retail traders heavily pile into a massive short position during a strong uptrend. It often serves as a warning sign that a huge squeeze to the upside might actually be coming. Retail traders often rely heavily on basic overbought indicators, trying to guess where the market will turn instead of respecting market structure. As the price continues to rise, these retail short positions face margin calls and forced liquidations. When a short position is liquidated, beyond sentiment data, another massive fundamental layer you need to know about is seasonal trends. We can look at the historical month-to-month performance data for gold over multiple decades to see what typically tends to happen during specific times of the year. Gold exhibits strong seasonal patterns due to commercial demand, jewelry manufacturing cycles, and cultural buying periods across major physical gold-consuming nations like India and China. When you analyze these seasonal trends on a multi-year average, you can see clear patterns emerge. Historically, certain months of the year exhibit a strong, bullish bias for gold due to this recurring physical demand and institutional portfolio rebalancing at the start of fiscal quarters. Conversely, other periods show a distinct tendency towards sideways consolidation or corrective pullbacks as commercial demand cools off. To further elevate your technical analysis on TradingView, you must master the art of identifying key liquidity pools and institutional order blocks. Gold is a highly liquid market, meaning that price moves are constantly drawn toward areas where massive amounts of stop-loss orders and buy limit or sell limit orders reside. These areas are typically found just above historical swing highs and just below major swing lows. When you are analyzing a gold chart, you should look for instances where the price aggressively sweeps a previous key high or low, only to immediately reject that level and close back within the previous trading range. This is often referred to as a liquidity sweep or a stop hunt. When you spot a liquidity sweep occurring on a higher time frame, such as the daily or 4-hour chart on TradingView, accompanied by a strong bearish or bullish engulfing candlestick rejection, it provides a high probability. Additionally, understanding the relationship between gold and real yields is paramount for mastering long-term trends. Real yields represent the nominal interest rate of a government bond minus the expected rate of inflation. This metric is the true gauge of the opportunity cost of holding gold. When real yields are in negative territory, meaning inflation is running higher than the interest you can earn on cash or government debt, Holding fiat currency guarantees a loss of purchasing power. Conversely, when real yields rise significantly into positive territory, cash and bonds provide a legitimate, risk-free return that beats inflation, making non-yielding gold far less appealing to macro funds. You can track U.S. real yields easily on TradingView by charting the 10-year Treasury inflation-protected securities, often ticker symbol TIP, or looking at the yield differentials directly. When the real yield curve begins to plunge, it serves as a leading fundamental indicator that a massive. Furthermore, you must develop a rigid risk management protocol specifically tailored to gold's unique volatility profile. Because gold can move hundreds of pips within a single 4-hour candlestick during high-impact news releases like the Non-Farm Payrolls (NFP) report or FOMC interest rate announcements, standard fixed pip stop losses can be highly dangerous. Instead, you should always calculate your position sizing based on a fixed percentage of your total account equity. Using volatility-based indicators like the average true range, ATR, on TradingView can help you determine the appropriate distance for your stop loss, ensuring that your trade has enough breathing room to withstand market noise without exposing your account to catastrophic drawdown. A professional trader understands that survival in the gold market is not about being right on every single trade. It is about keeping losses strictly controlled when the market invalidates your thesis, while letting your winning trades run to maximize profits. Ultimately, these are the exact tips, tricks, and structural data points that you need to integrate if you want to trade gold with a professional mindset. Success in this market requires a multidimensional approach that seamlessly blends macroeconomic fundamental drivers, such as Federal Reserve monetary policy and U.S. dollar strength, with precise technical execution and strict risk management on your charting platforms. By monitoring the DXY on TradingView, to actively improve your skills as a trader, you should commit to maintaining a highly detailed trading journal where you document every single gold trade you execute. Write down the fundamental catalysts that formed your directional bias, the specific technical patterns you identified on TradingView that triggered your entry, and the psychological state you were in while managing the position. Remember that the financial markets are a continuous learning curve, and the traders who achieve long-term profitability are those who treat their trading as a serious business, relying on statistical probabilities and cold data rather than emotion or gut feelings. Take these concepts, pull up your charts, map out your key macro levels, analyze the underlying dollar trends, and patiently wait for the market to present high-probability setups that align perfectly with your established rules. Consistent execution of a well-defined edge is the ultimate key to conquering the gold market.